And just like that, we're back for another Barometer Readings webcast. Good afternoon. I'm Pamela Hastings, Relationship Manager at Barometer Capital. Thank you so much for taking the time to join us this afternoon. As always, we will be joined by David Burrows, our Chief Investment Strategist and Portfolio Manager at Barometer Capital. He will be pleased to provide us with a macro overview and, of course, address any questions at the tail end of the conversation. If you would like to pose a question, please email me at phastings@barometercapital.ca or hit me up on the Zoom chat, and we'll be happy to address those at the tail end of our call this afternoon. I feel like I'm rusty. I've been away for a week. We also have Diana Avador, our head of trading, who will be speaking on the markets today and joining David in conversation. So we're pleased to have Diana join us this afternoon. And with that, I turn the conversation over to David Burrows. Good afternoon, David.
Hi, Pam. How are you?
I'm great. Thank you. I'm glad to see that you got your Tesla out of the snowbank.
Yeah, me too. I'm glad this week to be sitting in a sunbeam by the window. It is blanketed with snow out there, but it feels pretty nice to have some sun on my face.
Well, it certainly looks great. And I know we have lots to discuss this afternoon, so I'll let you take it away.
Great. Thanks, Pam.
So
yeah, we got lots to talk about today, so I'll move fairly quickly. I've asked Diana to jump on the call just to talk a little bit about some of the things we've seen over the last few days, but a very interesting few days in the market. I think the big question I've been asked by lots of folks over the last few days is, are we headed into some kind of a broad-based market correction? Or is this a continuation of the rotation we've been talking about now for well over a year? And so we'll look at the market action for some clues. As you know, we're big believers in not posing what we think should happen, but trying to look at the work that we do to get indication from the market as to what is happening. And I think that's probably the most important way to look at things. We got to be based in reality and be willing to take new information as it comes. So just quickly, as we always do, we'll start from the top. We have been in a structural bull market in stocks that started in 2013. It has gone on now 8 years, coming up on 9 years. It's not dissimilar to the bull market we saw in the late 1980s and 90s, where the S&P went up 18% a year over an extended 19-year bull market. We're not too different from the bull market that started in the 1950s, probably closer to that one, because the bull market that started in the early 1950s began with a slow and steady rise in interest rates that went on until inflation really started to take hold in the middle to late 1960s. When rates turn, it doesn't generally turn on a dime. It doesn't tend to happen in a hurry. There are a confluence of events that lead us from a disinflationary environment to a reflationary environment, which of course we have had the belief that we've been going through. If we take a look at long rates, you can see the picture. Rates bottomed during the Second World War. They started to rise in the early 1950s, but it took from 1951 through 1966 to move from 1.6% to 6% on a 10-year bond. Of course, then they continued on to move into the high teens here in Canada, in the US, a little over 15% by 1981. And as we always like to say, what works during rising rates is often quite different than what works during falling interest rates. And most people's experience investing has been all during a falling interest rate environment. And that perhaps put a lot of people on one side of the boat, focused on the things that have worked well for them over time. And I think that probably there are people realizing that some of those things may not be well suited to a rising rate environment. We have been seeing a pickup in inflation for sure. The question is whether it is something that will be transitory or whether it's something that will be entrenched. My guess it'll be somewhere in between, some combination of entrenched inflation, but some of it would be supply related. And as the supply bottlenecks debottleneck, we're going to see some of that come out of the system. But for now, this certainly is a concern. And as a result, we've seen the yield on a 2-year bond since September move from 20 basis points to 100 basis points. So a 500% increase in interest rate from that bottom, and arguably at 1% on a 2-year bond, still pretty low. But that is the bond market factoring in the likelihood and really inevitability of Fed rate hikes, which we're going to hear more about tomorrow in the Fed meeting. They're meeting today, and tomorrow they'll make a statement tomorrow afternoon. The market is very interested to hear. Certainly Powell has made a more hawkish pivot over the last couple of months and changing the language as to what he expects or thinks is within the realm of possibilities as far as inflation and rates and rate hikes and the rate hike cycle. So certainly the market has been grappling with that. I would argue in general, by the time you get to the first rate hike, a lot of that expectation has been built in. A lot of the repositioning has taken place already. History is through the first and second rate hikes, markets generally are pretty benign, but we certainly have seen the elephants moving their feet over the last few weeks. This is the 10-year yield and the 10-year bond going from the COVID lows of about 50 basis points back in 2020 to sitting today at around 177 basis points. They had their first leg up, as we've talked about. Rates consolidated through the course of spring and summer and started a second leg higher, which we think is going to go on for some time. So the bond market very clearly is in a bear market. This is the aggregate bond index made up of a basket of issuers, of credit quality, and of maturities. And clearly, prices for bonds have been moving lower. Shorter term bonds moving down a little less, long-term bonds moving down a little bit more, but it's been a tough value proposition for investors who are looking for income. Certainly, this has not been the place. Very small yield to be had, yet capital losses that more than offset them. We talked about commodity prices going through sort of a generational bottoming, much like they did in the early 1950s or in the late 1920s. We went from negative compound returns of close to 9% a year over the previous 10 years, a bear market, to now positive returns over the last 10 years. But generally, once you move through that zero line, it can go on for a very long time and ultimately wind up with 10, 15, 20% 10-year compounded returns. So this is a sector and asset class that we certainly want to pay some attention to. And there's the RJI ETF, which is a basket of commodities, unweighted, pure commodities themselves. And you can see that after being in a bear market from 2009 through 2020, where prices fell 77%, they have slowly been marching higher. We broke out in 2021, and really that has been continuing. And there is the RJI index as of this afternoon, what a relative strength, new high versus the S&P 500. So one of the things we want to ask is, when you get into a sell-off, is it a macro-driven event? In other words, is everything impacted? Or is it money rotating from one asset class to another, or one part of an asset class to another? We're going to try and tease that apart a little bit. The first thing I would say is commodities are showing no sign of weakness in this sell-off that we've seen over the last few days and few weeks. They made relative strength new highs versus the S&P. Certainly, money is working its way toward commodities, which would make some sense because they tend to move higher in price during an inflationary environment. We know that certain commodities are under supply constraints, and this has been an area of focus for us now for almost 18 months. On the other side, equities are a different story. So this is the ARKK, which is the ARK Innovation ETF. And this has really become the poster child for very high growth, unprofitable tech, the concept companies. And we know that in February and March of last year, we were inundated by commentary on TV talking about GameStop and talking about various meme stocks that had very little business, but share prices that were certainly moving themselves way higher. And really, this began a bear market in February, March of last year, and has gone on all the way through the past year. So the bear market slides down a slope of hope. People hoping that it will make a turn and work its way higher. You see failed rally attempts, and eventually people give up and start becoming aggressive sellers. And that certainly has been the case right up until yesterday, when you saw, some significant lows, but that ETF down 59% from the highs. Now, in a bear market, we always talk about breadth. The weakest securities sell off first, and eventually later in a decline, you'll get to the very strongest companies. Long duration or high multiple growth stocks have been under pressure because they are most impacted by rising interest rates. If you have earnings way off in the future and you have to discount them back to the present with a higher interest rate, then it means they are worth less. So as this sell-off took place, it impacted the stronger groups. As we got to the fall, software started to be impacted. The cloud-based computing companies started to get impacted. Even cybersecurity companies started to get impacted. And as we look at the NASDAQ 100, of course, dominated by the very biggest tech stocks, they really started to move sideways through late fall, November into December, and have had about a 20% sell-off as of yesterday morning. So that kind of meets that test of the strongest stocks getting hit later on. We've talked all year long about the fact that the percent of stocks trading above the 200-day moving average in the NASDAQ has been falling steadily, meaning the soldiers were falling away while the generals were marching on. And of course, the generals have been hit over the last 10 days. The month-to-date returns minus 11% for the NASDAQ rivals the worst months we saw in 2008. So this selling got serious in this group. Now, most of you know we've reduced our tech weight all the way through the year. We came into the year this year with less than half weight in NASDAQ. We'll talk a little bit more about that today, but certainly the selling has been concerted. Now, I thought maybe it would be useful to bring Diana Avigdor on the call today to talk a little bit about what we've seen going on and what we can take away from it. So Diana, are you there?
I'm here. Can you hear me?
I can hear you.
Hi, everyone.
So
well,
maybe I can flip slides
yesterday.
for you and you tell me what to do, but I'm interested in hearing your thoughts.
Yeah, it was a wild ride yesterday. And as traders, what we want to look for is to see whether it's sustainable or not. Yesterday, the market had a little bit of an accident and lost its footing. And at the low of the day, NASDAQ was down 5%, the S&P was down 4% before clawing back midday into positive territory. And so that was really nice to see because everybody was talking about whether it was overdone, and certainly there was a lot of short covering. But we want to look at what indicators or what metrics are pointing to whether it's sustainable bottom. And so there are some markers that we can look at. And you have put up this chart that I've shown you in the morning, and volume was absolutely a blow-off volume. And there's two little lines there, Friday and Monday. Both days were very high volume, and yesterday is record volume. So there was lots of business being done, lots of things were being cleaned up. That's the NASDAQ volume. So in all markets during this volatile time, there was a lot of money, a lot of business that got done. So arguably that is one metric that is supportive that perhaps we have put in some kind of climatic low yesterday when S&P and the NASDAQ were down 4 and 5%. Now, the option market in the US has become very large over the last few years, over the last decade, but definitely over the last 2 to 5 years and over COVID. And this is a chart that shows the put-call ratio. How many puts to calls have been traded, and the put-call ratio is very high. That's indicative of fear. People have bought a lot of puts. And without getting too technicals, but when there's a lot of put buying in the market, there is a lot of fear, which from a negative perspective, that's kind of capitulatory. And dealers that sell these puts to the people that are buying them, they have to hedge their position. Puts is a short position, and the dealer, to hedge his position, has to sell the stock because he has gotten into a contract to buy something from the client. So he has to sell. So it exacerbates the direction that the market was going in. So that is a marker that feels capitulatory. So we have volume on S&P, volume on NASDAQ is capitulatory. The option market showed a little capitulatory. And here is cash. Cash has been steadily going up in the institutional large client portfolio. This is an aggregate from Bank of America Merrill Lynch, which has a very large network of client, both on the prime and on the asset management side and on the retail broker side. So they really have a good color as to what an aggregate their client is investing in. And that increase in cash has happened year to date, and actually over the beginning of last quarter, really. So it is now at a fairly high level. So investors are not over their skis right now, and they have a lot of cash to deploy should the market hold. And what we're looking for hold short term is we want to see, today we had a down day, but it did not undercut yesterday's low. And that in essence is a positive. And I wouldn't have expected the market to blow up high after a trade like yesterday, because we also have the FOMC tomorrow. So new money has not been put to work today, but thankfully we have not undercut yesterday's low, and market has a little bit of reparation to do. There's been a lot of cleansing in the tech market. Yesterday, so this chart shows that the cash outlay, the cash outflow from the tech market is that little circle there that says January 22nd. That has gone from a decent amount of weight, and tech is about 29% of the S&P, 30% of the S&P. So to be at very little, close to zero, is to be significantly underweight. So investors have significantly de-risked that sector that is a very high beta sector. And
it certainly, Diana, is a well-loved sector. I mean, it's been a great sector for a long time, and there's a lot of great businesses. But what this is saying is that the number of investors who are overweight technology is really down to basically zero. So people are at market weight or sort of below. And the last time we saw this was December of 2008.
Yeah. And the money has flown into the cyclically sensitive sectors like the financials and commodities, and those allocations are now pretty high. Investors are, when we measure sentiment, they're more bearish now than they have been in the beginning of COVID. And that is understandable because the Fed has done a very hawkish pivot over a very short period of time. Equity markets and trading is not bothered so much by rate increases, especially not in the beginning of the cycle. So going from zero rates to a little higher than zero is not the point. It was the speed with which it happened. The speed of the bond market move always, equities don't like that when it happens so quickly. So Fed Chair Powell has pivoted a little quickly and then created this situation. So we'll see what he says tomorrow.
That's great. Thanks so much, Diana.
Pleasure.
So what does that mean for the rest of the market? This is the S&P 500 as of today. You can see, similar to the NASDAQ, very high spike in volume we saw in the last couple of days. The S&P traded below the 200-day moving average, and it's closed up basically at the 200-day moving average today. You can see at the bottom of the screen is something called RSI, or relative strength, and it shows that it has become more oversold than at any time since the COVID low, going back again to March of 2020. So very, very high volumes, reaching a very oversold territory. And of course, the S&P has a very big component of large cap technology or growth stocks in it after many years of outperformance. And so when the large cap tech stocks rolled over, it certainly impacted the S&P. I want to take a look, though, at the equally weighted S&P. This is an index, the RSP ETF. It's equally weighted of all 500 companies in the S&P. You can see each one is 0.2 of 1%. And interesting to see that since November, the equally weighted S&P has steadily been outperforming the market cap weighted S&P 500. In other words, the average stock in the equally weighted S&P is outperforming the S&P itself. And actually, we only briefly dipped below the 200-day, closing back today above the 200-day moving average. So important to see that the equally weighted S&P is outperforming. And that tells us the average stock in the S&P is doing a little better over the last few weeks than large cap tech. Again, going back to ask the question, is large cap tech and technology in general ready to take the whole market down? When we look at the longer term picture of that RSP, or equally weighted S&P, we broke out above the 50-week moving average at the beginning of the rally in 2020. We've stayed above it ever since. We tested it once, we tested it twice, we tested it a third time yesterday and went back above that 50-week moving average. So that is a positive. We've got a positive long-term trend. Certainly the long-term moving averages are moving higher, but a fair bit below, something that we're certainly keeping in mind. Other things that we care about. In the S&P, the percent of stocks making a 20-day low finally reached correction territory. In other words, if this is a garden variety correction, this is kind of where it runs out of steam. Now, it's not to say it can't be worse. A full-fledged bear market going into COVID, the fastest and deepest bear market in history, can certainly get more extreme. But I would argue that the news flow and the economic circumstances are far less uncertain today than they were going into a global pandemic. But certainly we've pulled back into the long-term moving averages. When we look at bull bear, we talked about the fact that the number of bulls, as of yesterday, only 20% of investors in the Investors Intelligence Survey were bullish. That again goes back to sort of correction low territory. And when we look at what happens to the S&P 500 when bulls get below 21%, there's a number of occasions where this happened. It's actually not so bad. 1 month out, 58% of the time, the market was positive. The worst case was a -6 out of all of these occasions going back to 1980. 3 months out, 82% of the occasions, the market was higher, an average 5.7%. Going out 6 months, the market was up on average 8%. Going out 9 months, up on average 14%. 1 year, 19%. 2 years, 37%. So short, sharp corrections are the hallmark of a bull market. They are not the hallmark of a bear market. When you take the NASDAQ 100, following days where there were more than 1,100 new lows, and there were 1,300 new lows yesterday, that's happened only a few times in history, that tends to be pretty sold out. A week later, on average, market was up 2%. A month later, up 6.6%. 3 months later, up 21%. 6 months later, 33%. 9 months later, 40%. 1 year later, 50%. 2 years later, 95%. So these tend to be capitulative sell-offs, and we're not ready to jump into tech. That's not where we see the leadership, but it does tell you that it might be getting to an extreme. Let's look at the S&P 500 when it has a quick correction. In other words, a correction that hits correction territory, 10% in less than a month. And we can take the fastest corrections going back over time. It took 14 days to get to 10%. We'll see what comes out, but 3 months later, you were positive. 6 months later, you were positive. 12 months later, you're positive in all but one, and that was in 2000 at the tech top. So these are all factors that we look at. They don't tell us what to do, but they give us some indication as to where we may be in the process. Let's look at some other things. We always care what credit spreads tell us. In other words, how much extra return a corporate bond investor or a high yield bond investor is demanding to take the risk to buy a corporate bond versus a government bond. We know that in 2020, going into COVID, well, the spreads blew out a lot. In other words, bond investors said, well, you're really going to have to pay me to take corporate risk. That's a problem. We've seen a little bit of widening, but really very little. So when you consider that bearishness is at the same level it was at the COVID lows, and that the percent of stocks trading at 20-day lows is at similar levels, The credit market is not telling you that there is a major problem in front of us. So that again is a divergence from that concerned outlook. Let's take a look at style. This is the value ETF, which we spent some time talking about, saying that it is starting to outperform growth. And of course, we've been focused in more value-oriented sectors. This is relative strength versus the S&P 500 since the beginning of December. Really nice outperformance, certainly trading above all the long-term moving averages. Let's compare it to the S&P Growth ETF, a very different picture. Falling relative price strength versus the market, broken below the moving averages. This is where the trouble is in the market. So let's move on. When you get into a major problem in the market, as they say, correlations go to one. In other words, diversification goes out the window, everything gets impacted the same way, and correlations spike. So in the COVID sell-off, all of the realized correlation between all 500 companies went to one. In other words, it's a stock, sell it. Let's look at this sell-off where everyone has become so bearish. Almost no pickup in correlation. That means the market is sorting good from bad. Money may be more moving from one sector to another or from certain companies to others, but it doesn't appear to be leaving the market. So let's talk about leadership themes, because in the end of the day, you care about where we are invested, not what the market's doing, right? We tend to have a very low correlation in the market. Our job is to identify the core areas of leadership in the market, focus on those areas without a bias, to recognize change quickly and be able to adjust the portfolios when those things take place. And in the event that nothing's working, we use our stop losses, be prepared to play defense and move some money to the sidelines. And generally, it's a combination of those three things. So if you're an income investor, the bond market probably is not the place for you. This has been something we've been avoiding all year in our macro fund. We've been short the bond market, continue to be. There's no sign that this pickup in concern is driving a whole bunch of people to jump with both feet into the bond market. Just not happening. It's also not pushing people into corporate bonds or high yield bonds. They are underperforming. It's not pushing people into high dividend paying stocks. These are companies with a high sustainable dividend, but very little growth. They act a lot like bonds. We call them bond proxies. Again, this has been an area that we've been short, but they are buying dividend growth securities. This is, as of today, the Morningstar Dividend Leaders ETF, very similar to the RDVY ETF. Both are invested in dividend growth stocks. Dividends are an important source of return over time, but look at the relative price strength versus the S&P. Well, I would say, as money is coming out of some areas, this is one of the places that it's going to. If we're going to get rising rates, you want a rising stream of dividends to help offset them. And certainly this is the camp that we are focused in our income portfolio. Virtually all dividend growth stocks, these are companies in our key sectors that all have raised their dividends, some of them dramatically over the last 12 months. And we would expect them to continue to, but these are not the sectors maybe people focused on 18 months ago. Companies like Newmont Mining, Nutrien for fertilizer, Rio Tinto make iron ore, Freeport McMoran in copper, ARC in tourmaline and natural gas, Crescent Point, Canadian Natural Resources in oil. Certainly the financials are seeing great dividend growth, and in the U.S. Again, we see in the rest of the sectors, again, lots of dividend growth across the portfolios. So this is something that we have believed is the place to focus in, and certainly dividend growth is performing well relative to the S&P. Let's move on beyond income. Let's talk about, well, actually, before we do, this is the GUNR. We talked about this over the last couple of weeks. Look at the relative strength going back to December versus the market. This is made up of large-sized upstream resource producers like ExxonMobil, Chevron, Nutrien, Archer Daniels, BHP, and so on. 3.4% dividend that's growing in double digits. I think that's pretty attractive. Market seems to agree. Residential REITs, multifamily residential REITs and industrial REITs have been hanging in quite well. Slow rising relative price improvement versus the S&P, and again with a nice yield attached, and certainly the banks. Now let's move to sectors that we're focused on in equity portfolios. Of course, they're also in our income portfolios. This is the ZEB, which is the equally weighted Canadian Bank Index. Again, you're going to see on many of these rising relative price strength versus the S&P. So if we think that these are breaking down, you're going to see negative price relative to the S&P. And you can see the Canadian banks certainly acting better across the financials. That has continued. And one of the things that we look at always is things pull back, but do they pull back within a trend? Or are they breaking trend? We use point and figure charts to help us determine that. This is the point and figure chart of the ZEB, which we just looked at. And when price is moving lower, it gets marked out in zeros. When price is rising, it gets marked out in X's. So of course, what we want to see is higher highs and higher lows, higher high, higher low, higher high in August, higher low, higher high in January, higher low. That is an uptrend. And so long as that continues, whether or not things pull back, we're probably not in a hurry to become sellers. This is the US KBE Bank ETF going back to 2008. We've talked about how we just broke out at the beginning of 2001, pulled back, and month by month, they've been working their way higher. Certainly the KBE also has higher lows, higher highs, higher low, higher high, higher low, higher high, and so on. Great price behavior there. So our biggest weight would be financials across US banks, Canadian banks, and insurance companies. Again, insurance companies seeing rising relative price strength versus the S&P. These benefit from rising rates. Let's talk about commodities. We've talked about the fact that commodities perhaps were putting in generational bottoms versus equities. So you can see that since 2008, equities, commodities relative to equities have been falling, much like they did through the 1980s and 90s until the turn in 1999, where the tech bust began and commodities outperformed, much like they did in the 1970s, much like they did in the 1950s. Copper, relative to the NASDAQ, underperformed for many years. We have a view that this is a shift that's taking place from a disinflationary asset to an inflationary asset. And look at that RJI, equally weighted basket of commodities. Certainly great made a new relative strength high today versus the S&P 500. We look at agricultural commodities. They broke this very long downtrend that they were in 2021. And look at the DBA ETF made up of agriculture commodities, making a new relative strength high today, trading virtually at the highs. Lumber, very similar, rising relative price strength versus the S&P. So across commodities, looks like that's continuing. Even gold, which has underperformed for some time, has made a relative strength turn sharply over the last few weeks. And if you look at a very long-term picture back to 2011, a bear market that took place, went on to make a new high in 2020, consolidated, and now just breaking out of this flag pattern. This is a pattern we often see in stock charts. It's called a cup and handle. Long consolidation, works its way sideways, and when it breaks out to the upside, tends to mean it's the beginning of a new move higher. So another commodity that's working its way higher. So gold relative to the S&P 500, reversing a long-term downtrend. So all of these things speak to rotation, not money leaving all assets. The question is, if you were to just sell your stocks, where are you going to go? Are you going to go to cash and sit and have it inflated away in a high inflation or higher inflation environment? Money is looking for the place where it's treated the best. It's looking for assets that have an ability to raise price in an inflationary environment, and all of these groups tend to do that. Oil, another great example, very close to new highs today for US Brent crude, a new relative strength for high versus the market. And when we look at the equities, this is the XEG, Capped Energy Index in Canada, made a new relative strength high today versus the S&P. And again, we look at the point and figure chart for confirmation, higher lows and higher highs, very constructive. This is the XLE index, which is made up of the largest oil and gas producers in the US, actually made a new all-time high today and a new relative strength high. So financials, basic materials, energy, all behaving the right way, and certainly relative to growth stocks. I thought this was an excellent illustration to say why it is that we think this can go on a long time. When groups come into favor, they become a larger and larger percent of the S&P as they go through their bull market. So this is tech and healthcare as a percent of the total market value of the S&P from 2003 through the present. And during that disinflationary period, this is the reality of the percent of the total market value of the S&P in energy and financials. We made a low at the COVID bottom and it started to reverse. So this, we think, is only the beginning of a shift that will take investors a long time to figure out. Everyone won't figure it out at once, but this is where we're focused. Consumer staples continue to do well. We talked about that over the last few weeks, that staples companies like some of the grocers and so on have started to outperform. And certainly we're continuing to see a shift from high multiple stocks to lower multiple stocks, but still there's a long way to go when we look at Berkshire Hathaway versus that ARK Innovation Fund. ARK Innovation Fund sure was a rocket, but this is a story of the tortoise versus the hare. The returns now since the beginning of 2020 for Berkshire, every bit as good as the rocket ship ARK Innovation ETF, but certainly with less of the ride. So here we are, we're now in earnings season. There's an important juxtaposition that I think we want to keep in mind. If you take basic materials, industrials, energy, and consumer discretionary, ex-Amazon, it makes up 20% of the S&P 500. These four sectors are expected to grow their earnings by 97.5% this quarter. They're expected to have revenue growth over last year, 23%. They're expected to grow their margins by 70%. And in the last month, earnings estimates for these four groups are up 9.5%. Let's take the rest of the S&P, 80% of the S&P. They're expected to grow their earnings 8.7% versus 97%, 10% revenue growth and 0% margin growth. We think it's important to be focused on those companies that can grow their margins and their revenues. And we think the multiples that investors will pay over time are likely to rise. So let's wrap it all up. First of all, the leadership groups remain intact. But the reality is this is a market of stocks and not everything works. So I've had many people ask, we've had some things turned down in the market. What does that mean for us? It means we get stopped out of a few positions. So our financials weight this week went from 24% to 20%. We lost 4% of our exposure in financials. It means that our energy weight has continued to rise. It means that our materials weight continues to be a significant overweight from market. But our tech weight has continued to come down, now only 6% of the portfolio. Real estate investment trusts have continued to be important. Consumer staples are a medium-sized position, and we've continued to have low weights in things like healthcare, communications, and consumer discretionary. You will note, though, that we do have a larger government bond position. That's us taking cash from stock positions and putting it in short-term bonds where we have very little risk from a capital perspective, and we've got a little larger cash weight. Now, it's unlikely that we're going to race out and buy broken down tech stocks with it. It's more likely that given the market's test of the leadership groups, we're likely to move more toward those groups that relatively outperformed during this correction. But we need to see a couple of things first. We need to see our short-term indicators turn back up again before we put new money to work. We need to see a follow-through day. So great that the market reversed yesterday off lows, but we want to see the market have a follow-through day, which would tend to have double the volume of an average day and a greater than 1.5% move higher in price. that would mean that it wasn't just short covering yesterday on the rally, but it was real buying taking place. Now it happens to be that the Fed is going to speak tomorrow, so that's going to be a catalyst. We're into the earnings period. We're getting more transparency on the companies that are beating and exceeding. There's going to be lots of food for thought over the next couple of weeks, but we needed a correction. And certainly this was a fairly targeted correction, but certainly it had some implications for all of the groups in the market. When we look at the global macro portfolio, it remains fairly fully invested. It's focused in financials, precious metals, energy, materials, dividend growth stocks. We've got some industrial weight. We've got some emerging market weight, arguably basic materials, some global stocks, and some specific equity sectors. We're short fixed income, we're short the US dollar, and we're short preferred shares. So emerging markets recently started to outperform for the first time in a while. So we do have about a 6% emerging markets weight, a 4% Asia weight in the macro portfolio, and very pleased with the setup there. So we're going to watch the earnings. Estimates have been rising, specifically for the groups that we're focused in. We're going to look very closely at how companies report. We're going to watch the trading daily and watch things as it relates to our models. But as it stands, it looks sort of like steady as she goes. We will get defensive if things were to get sloppier, certainly in our leadership groups. Sometimes it is that the whole market gets sloppy. Sometimes it is that very specific groups are the focus of the selling, which has been the case over the last few weeks. But certainly we got to take it day by day. And with that, Pam, if there are any questions, maybe we can answer them.
Thank you so much, David. We've had a couple of questions specifically on cryptocurrency. Both questions asking if Barometer is still bullish on crypto, and specifically they want to have a better understanding on our thoughts on Bitcoin and Ethereum.
Yeah. So in our macro portfolio, we do have positions in both. We don't hold those in the other pools or separate accounts that we're managing. I do see them as a separate asset class. It turns out they've behaved a little bit more like technology than I would have expected. But these are quickly growing platforms. They do tend to be a little bit more volatile. But I think that we are probably very close to a turn here, especially given how sold out tech seems to be. Again, it's a relatively small weight, but it's one that I think is important to have in one of the pools that we manage, because again, we're trying to have sort of a diversified approach here, and the macro portfolio is our biggest diversifier.
Thanks so much, David. This question is actually for Diana, given that she sits on that trading desk 24/7. Diana, Barry is curious, given the current aggressive selling and market pullback, do you see bigger opportunity in the near term to be in proven lower multiple tech stocks, or are you seeing more opportunity in cyclicals?
Well, we as a strategy don't try and pick bottoms. We like to see things with strength. A good stock should reflect its strength in its activity. So the cyclical stocks, the commodity driven, like oil, for market was down today, but oil was up 2%, and the oil producers acted really well. So that for a trade, it's not to say that this can't change, but for now, the cyclical and the banks were up today. It seems to be the easier trade. You might be able to pick cheaper technology stock, and there's certainly going to be opportunities, but I shy away from trying to pick bottoms. I'd like to buy and hold stocks that have exhibited some kind of relative strength. And I think we do this I know we do this in our portfolios too, as a strategy. Stocks that are not doing well, as soon as they go up a little bit, they're going to have a whole bunch of selling come into them, because there's going to be a lot of unhappy holders, and stocks that have kind of done well but have pulled back into some kind of trend, you'll have an easier long on those. So
it's a great point, Diana. I mean, one of the things that we spend a lot of time on is on a day like yesterday, where the market sells off aggressively and then makes a turn. What is it that pops back to the surface and goes positive first? And then on a day like today, when actually the market pulled back a little bit off yesterday's rally, what is it that holds its gains? And what is it that gives it back? And interestingly, many of the tech stocks that bounced yesterday got crushed again today. Whereas energy and financials and some of the materials were positive on the day, despite the fact that the market was down. So market was down pretty sharply, not anything like yesterday, but I know, for instance, the macro portfolio is up over 1% today, and virtually all the positions were positive. So, relative strength during a decline can also mean relative strength once the market starts to advance. And I think that that's an important concept. When you get into a bear market, if you start trying to pick bottoms, like if, for instance, this for technology was the beginning of a long period of underperformance, it could be a very frustrating process to try to be the one to pick a bottom. And certainly it saved us in 2001, 2002, and 2003, when tech stocks, the NASDAQ went down 70% over 2.5 years. So in order to get to that point, you have to have a lot of failed rallies. And so to try and buy those initial rallies is often dangerous, because very often they only rally because it's short covering, which is why we wait to see what we call a follow-through day, where over 5 or 6 days after the first day of rally, you get a big push, a second push higher. And then you want to see what is it that goes with the rally and what is it that fails.
Thanks so much, Diana. Thank you so much for joining us today. And David, we don't have any further questions for this afternoon, but as always, we'll be here at the same time next week. And if you have any questions, please don't hesitate to reach out. We're fully accessible. David, as always, I leave you with the final word.
Look, nobody knows for sure where the market's going. All you can do is have a process to make your decisions. Our process is stay with the strongest groups, as long as they hold their long-term trends. If something breaks down, be prepared to go to the sidelines. As you can see, we have a little more cash than we would typically have. We have a little bit of money in short-term bonds that we wouldn't typically have, because it's just somewhere to put the cash until we start redeploying it. Most of our positions have held in really, really well. Certainly our themes have been solid. And so, we'll see where we go from here, and we'll take it day by day. If there's major changes, we'll certainly update. And if not, we look forward to seeing everybody next Tuesday at 4:00. Thanks very much, everyone, for tuning in. We certainly appreciate your time. Everyone's busy. Thanks for joining us.